Hey guys, welcome everyone. Thank you again for joining us on Binomo Live. Today we're going to be talking about market volatility and what you can do to survive in the market and probably to succeed as well. There are specific steps you can take, and we'll be discussing this over the next couple of minutes. If you enjoy this video, be sure to share it with your friends and connections, especially those who love trading, so that you can both learn and discuss with each other what tips and tricks that could be useful to you to improve as a trader. I'm Ahmed, your host for today. So market volatility, what is the impact to traders? Market volatility is something that happens every day, no matter what the asset that you're trading, whether you're trading commodities, whether you're trading currency pairs, whether you're trading stocks, all assets that are traded on financial markets exhibit or show volatility, and you would be able to operate effectively as a trader and make profits as well as avoid losses if you understand why volatility happen and what you can do about it. Now, if you ignore volatility or do not recognize what volatility is, what tends to happen is you participate only based on your analysis, and that analysis could lead you into trouble and therefore losses. And if you make losses in a volatile market, it's going to be tricky to win back that losses because you don't know what's really happening, and all your analysis suddenly turns into a nightmare. So you definitely don't want that. People who study the markets absolutely understand that volatility is present, volatility is there, and you need to prepare for it. So yep, let me know if in the chat where you're joining us from, so that, or in the comment section, so that we'd be able to answer specific questions that you may have. Okay, so right now I have USD CHF on screen. What is probably more interesting if you look at assets that are against the yen. Today we have the highest volatility for yen crosses, assets that are related to the yen, USD JPY, Euro JPY, only because there were hints, there were rumors, there were even fears that the Bank of Japan might intervene and increase interest rates. Now, for this to happen, you have to understand the background of the situation. There you go. That's the volatility I'm talking about. So yen assets, yen crosses, and currencies that were linked to the yen today experienced this major shift in sentiment, because over the last couple of weeks the yen has been really hammered and its value depreciated so much that the markets now think that is not sustainable. And there were rumors, unofficial of course, saying that the Bank of Japan might step in and do an emergency or intervene with an interest rate hike to protect the yen and to save it from further decline. Now, when that rumor hit the market, it was about 5-6 hours ago during the Asian session. Immediately you look at the Euro JPY plunging all the way down. It moved from 170,966 all the way down to 166. Okay, so that's like 400 pips. And then again it went back up. It retraced a little bit to 168.5, and then before plunging again to 165. That's another 300 pips from here. Okay, so that is a lot of movement. That is volatility for you. So really in the market you have to understand that there's not one type of volatility. There's actually a few types, and we can also categorize this into different kinds of volatility so that you understand what the what your strategy is going to be for each type of volatility. The first type is flash crash. Okay, so flash crashes are sudden. It's a very sharp price movement, either up or down, and it happens for a very short time. Okay, so usually not lasting more than 1 hour. This is usually triggered by unexpected news events. It is triggered by technical glitches. Maybe there were pricing issues by the stock exchanges. Okay, and it could be some big player in the market, most probably using automated trading systems, algorithmic trading, and something went wrong with that system, and therefore huge volumes were moving things up and down, but it only happens for a fraction of the time, and it doesn't happen throughout the day. So flash crashes are bound to happen, and really you can't do much about it other than if you see it during the time it's happening, be sure not to trade until things settle down. Okay, because you don't know which side of the market you need to be on when flash crashes happen, and you don't know whether your analysis is good enough for the changing circumstances that's happening, because you don't know the changing circumstances, what's driving the flash crash. You don't know what's driving the spike of prices moving up or down. So you really want to step back when these things happen and analyze it again. If you have positions that are in profit, be sure to check your positions whether you feel comfortable with that position. If you are, then you can be open to opening more trades in the direction that's giving you profit. Or if it's really giving you losses and there's nothing you can do about it, be sure not to open any further trades to protect yourself from further losses. Okay, so flash crashes happen. It doesn't happen more than once or twice a month. In a typical month, we don't see it. So when it does happen, you want to make sure you don't make a mistake. Okay, so staying put where you are, protecting your existing balance is number one, unless you are of course the person causing the crash, which is very unlikely. Usually crashes are caused by news events or really big players in the market, and we want to make sure that we don't get hit by the wave of this flash crash. Okay, stay away. The second type of volatility that could happen is increased intraday range. Okay, increased intraday volatility. So this means large price swings, large price movements, more than usual, happening more than a couple of hours or maybe throughout the trading day for any given day. Okay, so the market's open Monday to Friday. So for example, if you're looking at an asset that is typically moving 200 or 300 pips a day in terms of its true range, and you can check that with the ATR indicator and look at the intraday, look at the daily candle, so you see what the range is. So suddenly you see price movements that are exceeding that range. Okay, so if an asset is typically moving 300 pips a day, and suddenly you see an asset that you are watching or paying attention to, or even the asset that you are trading, suddenly moving 400 pips, 500 pips, so you know this is increased volatility. What can you do? So there's really two situations that you can be in when there is increased intraday volatility. Number one is you expect the volatility to happen, because you have been scanning the market, you have been scanning the news, you have been scanning the geopolitical events that are affecting assets and the sentiment of traders. So you can probably see this thing coming. So with that kind of understanding or situation, you would probably be able to take advantage of the situation. Why? Because you sort of know that it's going to happen. You sort of know what assets are going to be affected, and you also know what factors are going to make the volatility go away. Because if, for example, the situation is caused by the Federal Reserve or the central bank ready to take action on hiking interest rates, and suddenly the CPI numbers comes out and shows that inflation is actually under control or below expectations, did not rise as much, and then you see the volatility happening, pushing the US dollar, for example, going down, weakening the US dollar. So AUD USD would go up, Euro USD would go up, GBP USD would go up, in line with weakening dollar because of lower inflation. So that volatility might continue throughout the day after that news events. So if you have anticipated that movement or that news or that situation, what you can really do is probably take an early position before the news happens with your prediction, and that position is not too large, so that in case you're wrong on your prediction, you're not going to lose the whole account. Okay, so you probably open one or two mini trades to make sure that you are right, and if you are right, you're going to immediately profit from it. And if you lose money, it's not going to be huge, because like I said, it's a mini trade. And then when the news unfolds and you see the asset reacting following the prediction of, the dollar weakening is consistent with the prediction that if inflation is not high, then the reverse is going to happen, which is the expectation is for the Federal Reserve or the central bank to not increase interest rates, or probably start to think about cutting interest rates. So preparing for it means that after the news happens, you can see if it's going to happen the way it should. The asset is going to move in the direction that it should, and then you making probably further trades in that direction, the direction of the trend, to be able to make even more profits. Okay, so probably you're starting before the news with one or two mini trades, and then when the news happens and you see the asset moving in a particular direction, and then wait for the pullback. And when the pullback happens, if it continues to move in the direction of the trend, you can open further trades to make even more profits from the volatility. So volatility is not something that you totally avoid. You can use volatility to your advantage, provided you understand what's really happening. Okay, so what's really happening and what kind of movement could be expected, and when those movements happen and materialize, you are there to be able to take advantage of it. Okay, so, and then let's look at the third type of volatility, and this is extended periods of volatility. Okay, so extended periods of volatility are a total change in perception, and this kind of increased volume of trading, increased range of price movements, or an extension of a very long trend, or a cancellation of a very long trend can happen. And extended volatility happens over many days, even many weeks. Okay, it does happen, and this could be due to something that is a new normal. For example, a global economic slowdown. And during the COVID time period, if you remember 3.5 years back, that was what happened. And if you look at the price of oil during the time, it was, it wasn't too high, but at the same time, it wasn't slumping like it was a recession that could not end. It was I think it was in around the $70-$80 range per barrel, crude oil at the time, WTI pricing. And then when COVID happened and all the lockdowns started to take place, and all the PMIs for all nations started to dive and go down, showing expectations of further economic weakness. And this did not stop after 2 months. It went on for 6 months, and then 9 months, and then 12 months. So then you look at the price of oil at that time during the years of COVID, it went all the way to negative. I can't remember what. I think it was negative $2 a barrel or something like that, because all the producers, the oil wells, once you start producing from them, you can't stop them for a while. It will keep producing until you exhaust the supply in those wells, in those oil wells. So all the production facilities around the world had to continue producing, but there was no demand. People were locked in at home. People were not able to go to work, and travel was basically down to zero. You couldn't travel on an airplane at that time as a tourist. They would put you in prison, most countries, I think. And there was nowhere for the oil to go, and for them to pump the oils and put them into container ships all the container ships were full, and then for the container ships to ship or transfer the oil through pipelines and to refineries and storage facilities, it couldn't exceed, it couldn't be sent anymore elsewhere because all the storage tanks were full, all the pipelines were not having a place to move them. Factories were not running, offices were not running, and homes were not consuming as much as if it was a vibrant economy and everything was normal. It wasn't a normal situation. So oil plunged from $70 a barrel, went down to -2, and it stayed there for a while. So that is a situation of extended period of volatility. I can't remember. Yeah, I think the market was open. Yes, the market was open. I remember. The Dow dived. The Dow Jones U.S. stock market dived some 30%, went down, declined by 34%. And then all the other assets, all of them were affected. And it was for a long time. It was many months. It was an extended period of volatility. The other situation was, of course, during the 9/11 attacks, when the United States, before it started that war with Afghanistan and Iraq. So it was crazy. It was a situation where things were in decline, and it stayed in decline for a couple of months. Okay, of course, the 2008 financial crisis was also another example. Markets went down significantly, and it stayed down for a couple of months. I think the Dow Jones recovered after 9 months, the Nasdaq recovered after 9 months, and so do other assets. They were all affected. So when extended periods of volatility happens, you can sort of identify it and separate it from other types of volatility, because flash crash happens only for minutes, if not seconds. They don't tend to last more than 1 hour. And then increased range or increased intraday volatility happens for a couple of days, maybe as long as 1 or 2 weeks, but not more than that. And extended periods of volatility happens for more than 2 weeks, 3 weeks, 4 weeks, even months. So there are things you can do to prepare for this. Like I mentioned, if you were aware of what the factors that are causing the volatility, you would be able to understand which assets would benefit, which assets would not benefit, and then take a position in those assets. Start with mini positions and then adding it up over time for as long as your prediction and your analysis is proven correct. If you cannot make sense of the volatility, you cannot make sense of what's going to happen next, the best thing to do is to paper trade. You can, if you love trading so much, you can paper trade. Go back to your demo account, start to open your positions based on your current analysis, if you don't know what's going on, and see if you are starting to make sense of things. Don't trade with your live account when you don't know what is going on. That is a recipe for disaster, and you're going to lose more money than you anticipate, and that's going to put you in a very disappointing position to be in, because you have to cover the losses when things get back up and the markets start to behave normally when things recover, but you do not have enough funds to trade, or have very little funds to make profit from those new trends that are more reasonable and easier to read. So when things are difficult, when things you can't make sense of it, stay away from the market. If you are in the middle of trading, stop trading, start to move to paper trade. Unless you want to take a complete break from the market, you may do so, because either way, whether you move to paper trading or you move to taking a break from the market, you will be able to protect your trading account balance. Okay. So some of the things that you could also do is to, when you look at things, there are situations where the volatility is increased. You can also do two things. Number one, avoid yourself from panic decisions. Okay, this tip actually applies even when you don't have increased volatility. Never act in a panic way, in a panic manner. always make decisions based on your trading plan, based on your trading strategy. Okay, whatever it is. If you don't have a trading strategy, I urge you to go back to your paper trade demo account and start to figure out what your trading plan is. What entries are good entries? What are good setups? What is your analysis? What is the basis of you going to open trades, whether up or down? What indicators are you going to use? What's the normal anticipation of if a trade goes your way based on your analysis? How far can it go? Okay, and if you know how far it's going to go, you need to also anticipate in terms of distance, in terms of time, because when you open a trade on the platform, you need to be able to tell whether that trade is going to be for what time period. Okay, you can't open a trade forever, because that more time in the markets means more risk. Okay, so be sure to understand, if you're analyzing on the 5 minutes chart or the 15 minutes chart, and the anticipated move, the move that you predicted happens, how long will it stay in that move? You can always study that based on on previous price movements. So make an assessment, make a decision whether it's going to move for the next 3 candles or 6 candles or 10 candles, whatever it is. You need to be able to tell what time frame you're going to exit the trade or close the trade, so that you don't expose yourself from trend reversals and, of course, unanticipated losses. Okay, and then, of course, second tip is you can also focus on learning during times when you can't trade, or whether things are just too difficult, whether the volatility is causing you losses or whether volatility is making it too dangerous for you to go into the market. You can always focus on learning. There's tons of resources out there on the internet, on YouTube and elsewhere. You can join live streams. You can talk to other traders either on Twitter or other forums or community spaces, and you can discuss and learn from other people. You can always check with them the kinds of technique that they're using, and if you have similar techniques with them, see if they have had more success. Why? Understand why. Or if they've dumped that strategy altogether and it's the strategy you use, so understand why they made those decisions, because you could learn something from them, that they've made so many more mistakes ahead of you, so you can learn from those mistakes and not repeat it and suffer as a result. And finally, there are situations where things go your way. When volatility happens, sometimes you make a profit from it and you are in profit and the trading is still open. So this is quite a dangerous time to be in, a dangerous situation to be in, because as you know, when you are most successful, that is when you are about to make your biggest trading mistake, especially when you did not anticipate that kind of success. Okay, when you don't anticipate making any success, all kinds of mistakes can happen, because you don't really know what's going on other than you are making money. Okay, so in those situations where you are in the fortunate side of the trade, you really need to go back to basics and focus on risk management. You need to understand why things are happening. You need to understand whether you've opened enough trades for the day. You need to understand how much losses you can make in one day, how much profit you targeted to make in one day. Now, if you were trading based on profits you made on the day, maybe you can, maybe you have a strategy where you can absorb more risk only if you're trading with profit money. But for some people, they exit no matter what. No matter what the situation, they exit, or they don't, if they've made the profit that they targeted for the day, they will just stop and let the market go. They'll come back again tomorrow. And some of these guys, even though they don't understand what's going on, they quickly reassess, and if they haven't made enough trades for the day, they will stick to their strategy and still make the same number of trades that they plan to make, but not blindly. Okay, because risk management is at the core of all successful traders. All great traders will say risk management, risk management, risk management. Rarely will you find great traders who will say forget risk management or do not mention risk management. Probably the only time you will see great traders who don't mention risk management is if you see influencers who are fake on the internet, on Twitter, on Facebook, or other social media platforms, where they say, yesterday I traded with 5,000 and in a month's time I got a Lamborghini. And throughout this discussion of how successful they are, Not a single time they mention the word risk management. So I urge you, stay away from those guys. Okay, so that's how to navigate market volatility effectively. If you've enjoyed this video, make sure you subscribe to the channel to get notification of future videos, and of course join us in future live stream. Give us a like, take the opportunity to benefit from the coupon code we have running for this month. Details are in the description below. You could use the promo code in the description to double your deposit, and I'm gonna see you in the next live stream. Take care, stay safe, and enjoy your trading.